All right, we are continuing our Future of series, and this time we're focusing in on the future of money and your retirement savings account. For more on this, Jamie Golombek is joining us. He's a managing director of tax and estate planning at CIBC Wealth Advisory Service. Jamie, good to always be able to catch up with you as we head into 2021. Investors very much focused on their retirement, their savings, and CIBC did a poll that says 40% of individuals are concerned that COVID-19 will have impacted their ability to retire and their ability to save through all of this. What's your thought on this front?
Yeah, well, certainly when we surveyed people, that was a concern. I mean, the good news is that with the vaccines just recently deployed in Canada, this is very positive news. Positive news for the economy, for the potential, and even for spending and saving. So I'm looking forward to a more hopeful 2021 in that regard.
But do you think it will delay people's ability to retire, the COVID-19 pandemic, and the fact that it will take us time to move out of this and see the economy recover?
Yeah, there may be a slight delay just depending on how old you are and also how prepared you were. We do have to remember that depending on what you were investing in, 2020 could have been a fantastic year for your portfolio. We know initially the government was very concerned in March. In fact, they even lowered the minimum RIF withdrawals that people had to make. But of course, many people with a diversified portfolio have actually done well in the markets for 2020. In fact, their retirement savings might even be above, depending on what they invested on when they were in the beginning of the year. So yes, I think it's very individual, very specific, but at the end of the day, you should have a plan, have a goal, and if the economy does rebound towards the second half of 2021, hopefully people will be able to get back on track very, very quickly.
You know, and there's a lot of focus right now, Jamie, on consumer behavior and what might change once we come out of COVID-19. David Rosenberg, of course, believing that people will actually continue to save and that we'll see the increasing savings rate go from 7% to 10%. That'll have a negative impact on the economy. Do you believe people will spend differently, or do we go back to what we used to be like?
Look, I think there is personally a pent-up demand for spending. I mean, for those of you who, certainly people that haven't lost their jobs, that are still employed, although it may be differently, working from home and such, but for those people who still do have jobs, and in fact, we've seen cash reserves build up enormously in people's accounts. And in fact, I think that there'll be a massive spending towards the second half of 2021 as people decide they can actually start to go out some more and do things, and spending on things like travel, entertainment, socializing, all kinds of things that people were not able to do in 2020. So, I think that all this cash that's been sitting on the sideline will certainly be deployed. At least a lot of it will be, and certainly those with jobs and those who have the ability to spend, I think will do that spending, especially if we get mass vaccinations across Canada. We get up to, 2/3 or 3/4 of the population vaccinated by the fall. I think that spells very, very good news for the economy and for spending in 2021.
And Jamie, as we think about, to your point, people will probably have a lot of pent-up demand. I tend to agree with you on that front. But let's, having said that, go through some of your key tips and advice as it relates to how to actually save for retirement in 2021, particularly given the fact that people probably have a lot of pent-up demand. Let's go through some of your top tips.
Yeah, so again, every year at this time of year, we just remind people that there are lots of opportunities for tax-free accumulation of savings in retirement. From the basics of the TFSA, you're going to get another $6,000 to sock away on January 1st, 2021 for long-term, for any need, although many people do use it for retirement. We, of course, have new RSP room. If you've got earned income, whether it's employment income, self-employment income, even rental income counts, 18% of that creates new opportunities to contribute if you're age 71 or under in 2021. And then, of course, people always ask me, well, what about the mortgage? I have a massive mortgage on my, on my home that I just bought a few years ago. Should I focus on that? And again, we're seeing mortgage rates at record lows. We've seen mortgages now at the 1.7, 1.8%, if not even lower. So again, my advice, generally speaking, each situation is different, but depending on how many years and your age, you may want to focus on that retirement savings with RSPs or TFSAs rather than aggressively paying down that 2% mortgage.
So if you're saying if your mortgage rate is below 3%, hold off on paying down your mortgage.
Well, generally speaking, that's the advice. I mean, assuming that you're going to take that money that you otherwise would pay down and invest it for the long term for retirement, either an RSP or a TFSA, where your effective rates of return effectively are tax free on the investment income. And assuming, again, you're going to put it into some type of diversified portfolio. Of course, if you're just going to put it into GICs, they're earning under 1%, then of course the better bet is certainly pay down your mortgage. But with mortgage rates really for many people even below 2% right now, probably it makes sense to save something for retirement using one of the tax deferred vehicles that we have available.
And Jamie, it's interesting as well, now that we're all at home and probably have a little bit more time because we're not going to holiday parties, etc. It's a good time to take a look at cash flow, your personal cash flow. But it's not always easy to really understand how to track it. So what's your advice on that?
Yeah, so this is what I'm going to do next week. I've taken the week off, and one of the activities I'm going to do during one of the days is certainly download all my transactions. So I go onto my online banking. I actually download my entire transactions for the year into an Excel spreadsheet. I can then sort it and see where I've spent the money in 2020 and what I might do differently in 2021. That's where I come up with a budget for my cash flow for 2021, and I can sort of prioritize. One thing I know that I need to focus on is multiple subscription services. I think I've subscribed to pretty much every type of video streaming that was available because there was nothing else to do in 2020. But do I really use most of this stuff? That's what I'm going to take a hard look at and see if I can save some cash flow. And I think many people will be in the same scenario as they start to review their 2020 expenses with a focus on budgeting for 2021.
Yeah, I had a service, to your point, a streaming service of sorts that I didn't use. I only, had it for maybe 2 months or so. I'm like, I'm getting rid of this. I did that about 3 months ago. But yeah, you got to really kind of check to see what you've signed up for and you've almost maybe even forgotten about.
Sure.
Absolutely. All right, Jamie, always great to see you and get your perspective over all these years. Thank you so much for being with us, and happy holidays.
Happy holidays to you.
Thank you. That is Jamie Golombek. He's a managing director of tax and estate planning over at CIBC Wealth Advisory.